Welcome back to the weekly market analysis for the week ending August 9th, 2024. After a summer hiatus, I am back and I'm here to talk markets with you. So if you are ready to jump in, make sure you hit the like button and subscribe to the channel if you have not. You can also see the insights that I post on Twitter at Mr. J. Thomason, and you can also subscribe to my weekly market newsletter at befinanciallyfree.substack.com. And the links to both of those are in the description of the video below. I've taken a hiatus from the videos, but not from writing the newsletter and not from tweeting, so you can definitely get a lot more out of following me on those places. So I'm going to take a minute and walk through all the markets, kind of what's been going on since our last video, which was back on May 31st, so it's been a little over 2 full months. And on the S&P, we're in the middle of a market drawdown, and just from the top of the market till the lowest close is about 8.52%. At the lowest point, we were close to 10% down for your typical market correction. Didn't quite get there. You can see I've got the moving averages. I've got the 20, the 50, the 100, and the 200-day moving averages on here. We've got the 20-day moving average crossing below the 50. Price obviously has broken pretty strongly through all but the 200. We're in the middle of a bounce up now. What'll be really interesting will be what happens when we get back to the 50-day moving average. If we just look at some recent history as a guidepost, the last time we broke through the 50-day moving average, we got close to the 100-day, came up, got rejected by the 50-day at first, then came up, broke above it, came back down below, and then broke back above again. This was earlier this year. And then when we go to last summer, the correction that started, we came down below the 50. We actually did get above it, tested it, came above, didn't make a higher high, and then came down below. And it was on the second move where we got actually cleanly rejected from the 50-day. And those are just 2 examples. And so as we think about what could happen on S&P right now, my read on this is you want to be careful if you think the market is going to go down further. I'll tell you why I think it's possible we could keep going up for a little while and maybe even up to new highs. I'm kind of open in this scenario. I'll tell you why in just a moment, but it would be entirely possible that this thing will break above the 50-day. So you don't want to be preemptively shorting if you're looking to the downside. You don't want to be preemptively shorting at the 50-day moving average. You'll want to see how price behaves at that spot. So anyway, equities have been on a little bit of a downslide. When you look at it on the in terms of the Nasdaq, sorry about the lines. Obviously, the big day was the CPI day. On the CPI day, the CPI came in lower than expected, super dovish print. Rate cut expectations went up, and the Nasdaq sold off. And that was kind of the beginning of the turn, really, in the way that the markets were responding to the news cycle. So this is one of the things that, as you look at markets, you have to really pay attention to what is driving markets, and it's plain as day. The tape will tell you what's going on. Prior to this point, any economic data that would have suggested that there was a chance of rate cuts or an increasing chance of rate cuts would lead to markets squeezing to the upside. Anything, whether it be something that would make bonds go up and yields come down. Those kinds of things were market positive in terms of equities. They have been for a really long time, essentially ever since the rate hiking cycle peaked, obviously, in the middle of last year. But even going back to late 2022, when inflation started to come off, again as an example, if we go to the Nasdaq back in November of 2022, the Nasdaq was up almost 7.5%. The first time that inflation really showed that it was coming down to any significant degree. And so, again, on July 11th, that's when the market narratives really shifted, because what was dovish was now being sold off by the market. And then you saw that really come in on the 1st of August when the jobs report came in, and the jobs were lower than expected, lower than expectations, lower than the previous reading, and the market sold that off really hard. And really the only thing that has kind of saved the market, I mean, this week has been, in my opinion, so a lot of people have been talking about the carry trade in Japan, among other places, unwinding. And all I would say is, I'm not going to say that it's not that, but I'm not going to say that it's only that. It's always a lot more than just one thing. And typically, as events start to unfold, like in the case of, market declines, these things are typically something that kind of gets the ball rolling, and then there's all these knock-on effects. And we could argue all day about what the main catalyst was or has been, but in the end, all that matters is, did you make money, did you save money, or did you lose money? And really, in my opinion, this week has been ultimately a story of better economic data in the U.S. That actually alleviated recession fears. Because I think what started to happen here is the market started to get wind of a growth slowdown, not just slowing but growing growth, but potentially recessionary issues in the U.S. economy. And the jobs data on the 1st, to me, was the real big sign that was taking place. And then what happened was, because on that day we got a low ISM manufacturing reading along with the jobs data, and then obviously Friday things continued to not look very good. Or I'm sorry, not Friday. So on Thursday, the ISM manufacturing data. So I realize, I apologize. I've been saying on the 1st it was the jobs data. The jobs data came on the 2nd. But in any case, on Thursday, the ISM data and then jobless claims brought the markets down. And then there was another really big drop on Friday with the jobs data. So people started to get really, really concerned. And then, of course, over the weekend, the Nikkei, the Japanese stock market, dropped. Just like I think it was like 13% or something like that. I don't honestly remember. I think I've got it down here. The Nikkei was down 12%, a little over 12%. And so obviously there was a lot of scares there. But then what's interesting is if you were to go back to, let me go to that day. So we had obviously Friday, the jobs report and all that stuff brought us down. And then if you actually go to Monday and you go to, we started to recover off the lows. And then at 7 o'clock here, you see the really significant green candle to the upside. We came up 163 points in 5 minutes. And that was because the ISM services report came in, and that suggested that growth actually was fine. We got the PMI reading over 50 and all that. And that's kind of been the saving grace of the market. And then, of course, we were bouncing. We kept coming up pretty high and then getting sold down into the close, coming up, getting sold down into the close. And then we got another sell down on Wednesday, and it looked like things were rolling over. And then what happens on Thursday is we got the jobless claims in, which frankly were mixed, but because the initial claims were lower than expected, it has just basically given markets room to run. And they really haven't looked back ever since then. And again, like the market was telling you what it wanted to do. It was trapping people to the long side before selling off, but then also not allowing the shorts to make any money. And then suddenly on Thursday, the market took off, pulled back a little bit, and then just never looked back after that. It only gave you the one opportunity. And then, of course, the market action today was pretty interesting because we kind of were going up and down and up and down and up and down, and then we went up pretty far and then sideways through the close. So it was kind of interesting. It was trying to throw people for a loop who were pattern seeking and trying to make the market do what it had been doing on the other days this week. So anyway, having said that, my point was that basically the services data and then the jobless claims on Thursday were basically the saving grace of the market. Otherwise, we could have been looking at a completely different story. Now, the market was pretty hard oversold. It was getting very oversold. The S&P, if we use the SPY as the indicator, my system's actually triggered for a number of reasons, but one of which being that the RSI hit a specific buy zone level when the markets are in this sort of trend. And so from a system standpoint, that was actually a good thing because market's up since then. But the question is, what's going to happen going forward? I mean, is the ISM and is the jobless claims, are those things sufficient to show us that there's not actually a growth scare? If a lot of people are correct in the yen carry trade being a big problem. I mean, if we look at, let me go to my futures chart for just a second. If I go to the yen chart, sorry about that. If I go to the yen chart, I mean, this is kind of what's been happening. So the July 11th, that's the CPI day. Basically, since then, that thing has started to unwind. And after Monday, we've just been coming down ever since. So is the carry trade over? My futures, the COT data actually is now showing, compared to the last year, that now the speculators are longer than they've ever been. So now everyone is trying to chase this yen trade. And the commercials, which are the hedgers, they're actually at the shortest that they have been in at least a year. And so at this point, because this trade has been working, has been unwinding, right now everyone, I mean, it's kind of crazy. I feel like Michael Guyad was the only one talking about the reverse carry trade for a while. And now in a week, it's basically become the thing that everyone knows about, everyone's talking about. That, and I think the SOM indicator, or the SOM rule, which is the unemployment rule. And because those things, now it feels like everyone's trying to become an expert on those things. So I kind of get the sense that, this story might be peaking, at least for the time being. And so that has me thinking that there's room here for the yen to come off, for equities to go back up, because right now I think everyone's really, really concerned about that. So that's kind of my read on equities right now. I think that there is some room for them to go up. Another reason I think equities can go up in the near term is the AAII sentiment. That's one example of a number of indicators that I look at that are, that are supportive of more bullish price action. We're still above the historical average in bullish sentiment. You can see here 40.5% bullish. But we're also higher than the historical average in bearish sentiment. And so right now we do still have a lot of bulls in the market, but there are a lot of bears in the market too, freaking out. It's not as high as it is often, last year in November, if you look down at the 50.3%, that's the 1 year bearish high. That's about the level, like that's in the 90th or above percentile of readings on that over the time series. And so when you get to that level, that's where you're more at durable bottoms. So we're not quite there yet in terms of bearish. So I guess my point is, I'm not suggesting that this is the bottom. It could be, because the AAII sentiment was not at a low here in April, and it wasn't at lows at various other points. But in any case, it just means that there is room for some upside. And then you have to kind of follow and see what happens. I mentioned the COT data earlier. So when you look at the COT on equities, you actually see that speculators are getting longer here, but they're not max long. And so, again, what that tells you is that there is still room for the markets to go up. So what I'm going to be watching for is over the next week, if the markets go up, then are we going to see sentiment again starting to move back up with the market? And are we going to see speculators continue to get longer on the COT data? Because one of the things that has been happening over the last, especially the last like 18 months, is that the markets have been just ripping to the upside, and everyone's been talking about, oh, equities are overvalued, equities are overvalued. And really the problem is people aren't in the market. They want to get in the market, but they don't want to buy at the high levels, so they've been waiting for a big pullback. And it's just funny to me because if you think about since November of last year, we just had this ripping rally into the end, and everybody was talking about, oh, it's gone too far too fast, I don't want to buy, I don't want to buy. Well, I mean, even with this pullback, prices are still higher than where they were at any point during that during that run. So it's kind of funny how that works. That's how sentiment works, though. So my suspicion is, like, I think there are a lot of people out there who think it's kind of interesting. My read on it, it feels like a lot of people are saying, okay, this is where you buy because there's not going to be a recession. For as many people as there are that are ringing the alarm on the yen carry trade or on the SOM indicator and recession fears and things like that, there are a lot of people who are saying, oh, this is where you buy, this is where you buy, markets are oversold, this is where you buy. So I don't know, I feel like there's room for it to go up, but I want to wait and see how price reacts when it gets into this 5,400 to 5,500 on the S&P. I want to see if we are going to stall out there, or if we're going to end up going and making at least testing the all-time high, and then see what happens there if that happens. So I wanted to point that out. Another big news item was the VIX spike. So everyone was freaking out. The VIX went up to 65, which is pretty wild. We haven't seen a VIX at that level since COVID. So, and then of course people have been looking at all these charts where, and I've got some junk on my VIX chart here, that we've only seen these levels a couple of times back in, 2020, the Volmageddon episode in 2018, in 2015, and then of course the GFC over the last 15, 16 years. So that's interesting. But usually when you see a spike like that, fading it is doing the short VIX ETF. A lot of people were talking about that, and that's been a pretty good trade, I would say, right? Actually, I think we can actually look at this. If we go to SVIX, yeah, if you look at that, if you bought it down here, that's a pretty decent gain. Of course, if you were already long, this is a horrendous drop. So that's kind of the thing when you do inverse ETFs or leveraged ETFs. Another thing I want to talk about is the bonds. So I've got a bunch of different illustrations on here. I'll get rid of them. Actually, I don't want to get rid of that first one. So I have been watching this trend line for some time. And of course it broke, got retested, textbook retest there, and it's been selling off. So I'll get rid of this now. But one of the things I've also been watching is on my probable range indicator. So on the price action on Friday, and I even wrote this in my newsletter, we got sold pretty hard, piercing the probable range. That's a buy at like every opportunity, right? So and ever since then, or I guess in this case it would be sell bonds, and that's a pretty good trade. I mean, it's just oversold. It doesn't mean bonds are going to just go to or that the yield is going to go way up now, but if anyone thought that this was just going to keep waterfalling down, like, that was absurd. So that would have been a good short bonds, long yields trade there. So right now the yields, the yield story is really interesting because you've got the 10-year 3-month, and that blue line is where I predicted a recession would be starting based on some studies of the yield curve that I've been doing, so I'll leave that aside. But the other one was the 10s 2s, which at one point actually disinverted intraday on Monday, and then of course got sold down, and it's kind of just been coming down. It went up for a few days and then went down ever since then. So The yield curve has been a big story. Of course, everyone freaking out here, thinking, "Oh, recession, recession," and time will tell. But this is why overreactions and not having a system, not having a process, that's what gets you wiped out. And then another thing that a lot of people are watching are credit spreads. We had credit spreads move pretty strongly. Let me get rid of my moving averages here. Credit spreads were moving pretty strongly. Still well below the high risk threshold, but that was definitely getting everybody's attention. Credit spreads tend to spike with the VIX, so that makes sense. But it has come down pretty strongly ever since then. So it's something to watch, but I'm not sure if it means anything. I think this might have been a overreaction, and then the big question is, are we overreacting the opposite direction to the overreaction? And that remains to be seen. And then the other thing I want to talk about was Bitcoin. We are still in the window. So for those of you who don't know, haven't been following me on Twitter, this window is the average window of time it takes for price to make a new all-time high around the time of the halving, at the time the correction takes place. And so we're still well within that window. So it wouldn't surprise me at all to see price move around a little bit sideways. We basically have until mid-September to make new all-time highs for this this story, or this this pattern to persist. This is the type of sideways price action that makes people lose interest in crypto. So or makes people lose interest in the trade, because right here, once we made a new all-time high, everyone was talking about how we had to double in price in less than 30 days, and people were talking about, oh, once the halving happens, it's going to, like once the ETF happens, we're going to go to 100,000. Halving is going to happen, we're going to go to 1 million, and all that. And the excitement was so frothy here, and there have been a couple of these head fakes. And so this is the type of price action that just grinds people out of their positions. And what's really interesting is on the COT data, the small speculators in Bitcoin are as short as they have been in a really, really, really long time. And so people are actually positioning for more downside in Bitcoin, at least using the futures, so in the CME futures. So I think that that's a really interesting thing to note as well. So, I mean, really, like, risk assets have been in a pretty significant drawdown, and time will tell on the direction in the medium term. My suspicion is that we're going to see some movement to the upside over the next week, and I'm not sure if or when it will stall out. But I definitely know on equities I'm going to be watching the 5,400 to 5,500 level to kind of see if things stall out in there. It's going to be really important because next week we have PPI on, I believe, I think it's on Monday or Tuesday, and then CPI is the following day. So we've got some really important data coming in. So if the CPI comes in really soft or even negative, then that's obviously going to create some more growth fears, some deflation fears. So that's going to be something you're going to want to keep track of. Again, based on kind of what I'm seeing around the markets, to me, I kind of get the sense that they're going to go to the upside a little bit, and then we'll kind of see what happens from there. And then I think that's actually going to be it for today. Oh, talk about some breadth for a second. I like to throw up the breadth indicators. They've been really, really choppy around the 50 level for a while. And it's been interesting watching the longer term growth, or the longer term breadth, so stocks above their 200-day moving average in the S&P. It's been kind of like meandering, and it looks like it wants to curl down and move lower, but it hasn't yet. The ones on the NASDAQ haven't looked very good. The ones on the Russell haven't looked very good as of late. If you look at the Russell 3000, the shorter term 3,000 stocks above their 50-day moving average doesn't look very good either. So these are all things that are important to watch. Something that I've been pointing out more recently has been the ratio between junk and treasuries. So this is another way to think about the credit spreads. I like to look at these ETFs as an indicator, and they're obviously below their tide indicator, so I would be watching to see if this crosses. Recently the high beta to low beta ratio like collapsed, and that crossed, and that's usually not a good sign of things to come ahead. And then if that's crossed and then this one crosses, then that's bad news bears. You can also look at the looks like the utilities. This actually, I'm glad I just looked at this kind of on the random, because I want to talk about this for a second. The ratio between the SPY and XLU, which is the utilities ETF, utility sector ETF, has just crossed bearish tide. And I want to highlight that because this is a really important and interesting risk signal. Now, I did a study on this ratio because what the reason I did is because I went back and I looked, and I saw that back in 2021, you saw that this was coming up, and then it peaked in November, around the same time that tech peaked, and then started to come off, and then the tide indicator crossed in February. And of course, we know that from February, or from, for all of 2022 up until late September, we were in a bear market. And then of course we bottomed, we bounced, and then in early February 2023, we crossed to the upside. And so to me, I was saying, wow, okay, utilities, strength in utilities relative to the S&P 500 is actually a really good indicator. So I went back and I checked across time, all the times where those crosses happened on my tide indicator. And the hit rate is not actually very good. But the reason why this is important is because when the SPY to XLU ratio is in bearish tide, if there is a market downturn, it is often very, very, very severe. The average drawdown, so what I did was I studied the price action, and it was a little bit less than 50% of the time there is a drawdown. And when there is a drawdown, the probability of it being a more than 10% correction is actually really high out of those times where price was in drawdown. So, and then on a few occasions, it was more than 20%. So to me, this is really important as a risk indicator because ultimately what it's showing you is that the risk of tail events to the downside are much higher, and you need to manage your risk around that. So it's a really good opportunity. It's a really good signal to tell you, hey, you need to hedge, or you need to go flat in the market, at least for the time being. And so I would just say that as well. So I'm glad that I took a moment to check that out. So I'll stop there. Thank you for tuning in. I know it's been a little while. I'm hoping to be able to go back to doing this on a fairly regular and hopefully weekly basis. Again, if you liked the content and you thought it was helpful in thinking about the markets, then hit the like button, share it, subscribe to the channel. And with that, I will see you guys next time.